Hello everyone, and hope you guys are doing well and studies are going in full swing. In today's video we would be discussing another important chapter in your CA final AFM. This is a chapter on mutual funds. Now preferably this chapter should be done after the chapter on portfolio management, so that a lot of things in the return calculation or performance evaluation are broadly clear. So if you have not done portfolio management, first try to finish that and then come up to mutual funds. It's a fairly scoring and easy chapter. So let us get started. First of all, when we look at the mutual funds, what are mutual funds? These are basically collective investment schemes where a fund will collect money from individuals, from entities, small contributions, and then pool that together and invest it in companies. They can afford to recruit very experienced and talented, probably chartered accountants and professionals like yourself, so that the funds can be managed in a very efficient way. Now there are two types of mutual funds. First, there is something called as a closed-ended mutual fund, and then there is something called as an open-ended mutual fund. As the name goes, an open-ended mutual fund is open for entry and exit whenever the investor wants. So a mutual fund is hungry for money. Whenever they receive money, they can deploy it in the market, and whenever someone asks for redemption, they can sell the stocks in the market and meet the redemption calls. So over here the mutual fund is open for entry and open for exit whenever the investor wants. A question might arise at what value will this mutual fund allot units? Units are in a mutual fund. What shares are in a company? At what value will they allot the units, or at what value will the units be redeemed? So the answer to this is there is something called as a net asset value, which is calculated on a daily basis. So if a new investor wants to invest in a mutual fund, they will invest at the applicable NAV for that date, and if an investor is redeeming a unit of that open-ended fund, the fund is going to pay based on the NAV of the applicable date. Now if you compare a open-ended mutual fund to, let us say, a closed-ended mutual fund, as the name goes, a closed-ended fund is a closed fund. That is, like a company does an IPO for a specific number of days which remains open, a closed-ended fund does an NFO, new fund offer, for a specific number of days in which an investor can invest, and after that the fund will not accept any new investments, or it will not do redemptions before the specified date is over. So what if an investor wants to exit this fund in the middle? Well, they will have to go to the stock exchange and sell the units of that fund at the applicable price, which may be close to the NAV as well. However, they cannot go back to the mutual fund and demand their money back, or they cannot later go to the mutual fund and be ready to pay the money to get the units. So these are called as close-ended mutual funds. So when you look at these funds, an important assessment is how do you calculate NAV? NAV is net assets, that is assets minus liabilities divided by number of units. So the assets over here for a mutual fund is typically the fund portfolio of equity shares, etc., in which they have deployed money, the fair value of those assets minus whatever is the liabilities. Again, liabilities may be fund management charges payable, or any other expense which is payable can be liability. Subtract it, get the net assets divided by the number of units, and that will give you, let us say, the NAV. So while you calculate the NAV, you will take the assets and liabilities at market value. You will take of all investments, shares, bonds, etc. You have to be careful in cases where cash balance is also to be calculated. So over here sometimes you might be said that there are 200 crores worth of cash, of which 190 crore is spent for buying investments. Then there will be some dividend received, some dividend paid, a lot of adjustments to give you the cash balance, which is a part of your net assets as well. So cash and bank can be a tricky calculation. Receivables can be for dividend or interest, minus liabilities can be expenses payable like fund management charges payable. Gives you net assets divided by number of units, will give you the NAV. The NAV, mind you, can change or will change rather every day as the market value of investments, number of units, etc. keeps on changing. And a lot of times for industrial training, etc., students are also kind of recruited for calculating and checking for NAVs for various funds. Okay, next you go to the investor return calculation. Now one can always say that this is similar to what we have done in portfolio. The answer is yes. Like the return of a single security. Here the security can be a fund, is calculated as P1 minus P0 plus D upon P0 into 100. For a fund, instead of P1 minus P0, you will do NAV at period 1 minus NAV at period 0 plus the distributions. The distributions can be in the form of dividend distributions, they can be in the form of capital gains distributions or any distributions, divided by the initial NAV at 0.0 into 100. This will give you return for a single period investment, that is for 1 year. But in most mutual fund questions, what you will be given is, sometimes you might be given, let us say, a 10-year period, that is around 120 months. Sometimes you might be given a 3-month period, and as a result, you might be required to calculate an annualized return. So for example, if you have invested for 33 months and an annualized return is to be calculated, you will say that this is NAV at month 33 minus NAV at month 0 plus the distributions during that time frame, if any, divided by NAV at 0.0. This will give you the holding period return over the 33 months into 100 for percentage into 12 by 33. And this will give you, let us say, the annualized return. So whenever you see the words annualized return, it is always a per annum return. So this can be for 33 months. If, let us say, this is invested only for 3 months, in which case you will say NAV at the 3rd month, everything else remains the same, into 12 by 3. So basically doing an 12 by n adjustment is going to convert your holding period return into what you call as an annualized return. Institute usually uses the simple interest working. Alternatively, you can even do compounding for more than 1 year, but preferably Institute does a simple interest working, so you can also do that unless it is specifically required in the question to do other way around. So over here, distribution can be made in various types of schemes. Now, for plans, there are two very important types of plans. One is a regular dividend plan where I get dividend as cash, and then there is a dividend reinvestment plan. Now, in case of a dividend reinvestment plan, if an investor opts for that plan, the mutual fund will declare the dividend. If you have opted for the dividend reinvestment plan, then the mutual fund will utilize that dividend to allot new units to you rather than paying you dividend in cash. So dividend is getting reinvested, but this dividend will get reinvested at what rate? Well, at the NAV on the date when dividend is paid. In a regular dividend plan, there is no reinvestment. The dividend comes as cash in your hand. In a dividend reinvestment plan, instead of dividend in cash, you will get units of the mutual fund. Now, usually a dividend reinvestment plan is better in case the NAV of the fund is growing. How will we know in the exam if it's a dividend reinvestment question? Typically, if the number of units are increasing, then that increase is usually due to dividend reinvestment, and that is how you probably infer whether it is a dividend reinvestment plan if the question remains silent. Apart from that, there are two other types of plans. One is a bonus plan and one is a growth plan. Under the growth plan, there is no dividend, there is no bonus. You invest and then the fund uses all the money to probably grow, and hence you will probably exit at a much higher NAV. In case of a dividend plan, you will get regular dividend. If there is a reinvestment, then you will get units on reinvestment of the dividend. In case of a bonus plan, you will generally not get dividend. However, the fund will continuously declare bonus, and bonus ratio is new is to old, and hence you will get more units on account of the bonus. So there is a regular plan, important being dividend reinvestment plan. And then there is other plans like the growth plan, bonus plan, etc. Now what one needs to remember is, especially in cases of dividend reinvestment plan and bonus plan, your return calculation might be slightly different. Usually the return can be calculated on a per unit basis. However, whenever it's a bonus plan or a dividend reinvestment plan, you might have invested to start with 100 units, but at the end you don't have 100 units. You probably have 150, 160, 180 units. And hence, you don't receive any separate cash flow, but you receive more units, and hence to consider the effect of those additional units as well, you will always try to calculate return on a total basis. Remember, this is for a dividend reinvestment plan as well as bonus plan, where you will take the total NAV at the end of the period, that is old plus new units, into the NAV at the end of the period, minus total NAV at the start of the period, upon total NAV into 100 into 12 by n. Where your total NAV is the old plus new units into the NAV at period 1, and the new units can be calculated as total dividend upon NAV at the dividend distribution date. That will give you the new units. Okay. Next, you look at a concept of something called as dividend equalization. Now, dividend equalization, there is one particular sum in the material for which we have put a separate video as well, which you can refer for a detailed understanding of dividend equalization. So when we look at dividend equalization, what happens in a lot of funds is you might be giving dividend at a specific dates, but there is people entering and exiting at different dates, and as a result what you do is you calculate dividend equalization. This is a charge that is to be paid by a new unit holder who is entering along with the opening NAV. He or she will pay a dividend equalization charge which is based on the income earned by the fund till date divided by the existing units. That will be added. Whereas if a person is exiting, redeeming before the company pays dividend, the fund pays dividend, then the dividend equalization will be paid along with the opening NAV to the redeeming holder. Now, how do you calculate the dividend equalization? It is income earned during the period upon the existing units during the period. That will be the dividend equalization per unit. Usually, in case of dividend equalization questions, which are relatively rare, you will be given the opening NAV. If there is any load, we will study what a load is. Load is, entry load is an additional charge which is levied on a new investor when they are entering. Exit load is a charge which is levied on an unit holder when they are exiting the scheme. If there is a load, you will add the entry load or subtract the exit load for calculating the amount to be paid. In either case, if there's a dividend equalization, the dividend equalization charge will be added for the new unit holders as well as for the redeeming unit holders because I have to pay them. So dividend equalization should be added to the opening NAV. Entry and exit load is on the opening NAV, excluding the dividend equalization, and your income available for distribution is a profit earned plus or minus dividend equalization that is collected. It is best if you kind of refer a numerical if you're not very clear with this. And we have solved a separate, if possible I'll share the link over here, otherwise you can even just check on YouTube. You will find a dividend equalization detailed video with explanation of the concept as well as the sum. Now there are 3 fund management strategies. Again, this is something which is there in the study mat. We have done sums on that as well, but institute usually does not ask you much on this. When you look at fund management strategies, there are 3 strategies. One is a buy and hold. So you buy and you will hold it. You will not really rebalance or do anything. Second is a constant ratio strategy where, let us say you decide a ratio like 50:50 for debt and equity. Then you have 2 lakhs, 1 lakh and 1 lakh you invest in debt and equity. At each agreed date, let us say every month or every quarter, you will check whether they are still 50:50. If they are not, you will rebalance. That is, if the equity has become 1 lakh 30, debt is still 1 lakh, then you will say your portfolio is worth 2 lakh 30, out of which 50%, that is 1 lakh 15 should be debt, 1 lakh 15 should be equity. Currently 1 lakh 30 is equity and 1 lakh is debt. So you will sell equity worth 15 and deploy that money in debt. That is constant ratio plan. Sometimes some funds put thresholds that they will say that they will only rebalance if the change is, let us say, more than 10%. If it is more than 10%, they will rebalance, otherwise they will not. They will continue till the time the change actually becomes 10%. So that is something that you might have to check if there is a threshold put for rebalancing. Like if the rebalancing were to happen only if the change is more than 20%. If you are moving from, let us say, a value which is just increasing by 5%, then you will not rebalance. So you will have to see in such questions if there is a threshold. Next, you have the constant proportion portfolio insurance, CPPI plan. Here you try to develop a strategy where you find what is your minimum acceptable value, that is floor. So if you might have a portfolio of 1 lakh rupees, you are ready to expect bear a maximum loss of 10% over the course of, let us say, 1 month investment horizon. So over here you might say that your floor, for example, if this is 10%, your floor is 90,000, and hence 10,000, let us say, is your cushion. This is a cushion against which you can play around. So CPPI says that ideally when you invest, the cushion into the multiplier, if nothing is given, multiplier is 1. If it is given, you will take that multiplier. Like for example, multiplier is 2 times, then 10,000 into 2, which is equal to 20,000. This 20,000 will be invested in equity, but your portfolio is only 1 lakh, which means the remaining 80,000 will be invested in debt. Now, as each period passes, like for example, your agreed rebalancing is happening after 10 days, you will try to find the revised cushion. Like for example, your equity has gone from 20,000 to, let us say, 15,000. Your equity has fallen, debt has remained the same at 80, which means 95,000 is your revised position, but your floor is 90, and hence your cushion is only 5,000 now. multiplied by 2, 5,000 into 10, 10,000 should be in equity, but currently there is 15,000 in equity, so you will sell 5,000 of equity and deploy it in debt. So your rebalance portfolio will be 15 minus 5, that is 10,000 in equity, and the remaining 85,000 will be put in debt, and so on. So this is if you want to cover the CPPI as well. Then there are loads, as we said. When you look at load, there is entry load, which is levied on an investor when they enter the scheme, exit load, which is charged from the investor when they exit the scheme. Usually most of the funds today have removed load. However, if a question tells you, you will consider the effect of load. Load is applied as a percentage of the NAV. And then you have certain questions which is linked to fund evaluation. So when you look at fund evaluation related questions, there are three common ratios. There is the Sharpe ratio, that is RF, the return of X minus RF divided by standard deviation, which is considered to be the best ratio. There is a Trenner ratio, again Rx minus RF, but this time divided by beta. Jensen's alpha, that is the actual return Rx minus the required return, let's say KE. And then there is also Sortino ratio, which is again Rx minus RF, but divided by what is called as downside risk. Usually institute does not ask you a lot about Sortino ratio, but in case it comes, you should be aware that there will be a downside standard deviation that you consider rather than the total standard deviation. Downside standard deviation will be given to you in the question. If you have to gauge which of the fund managers is the best, generally Sharpe ratio is considered to be the most superior ratio, because it considers the ability of the manager to diversify. If they have diversified, unsystematic risk would reduce and then standard deviation would fall, thereby increasing the Sharpe ratio as compared to a fund manager who has not diversified. So these are the basics regarding mutual funds. If we have to do a few questions on this, so let us say we go to our Super 90 question set and we go to question number 1. Okay, let us review these questions. Now Mr. D had invested in 3 mutual funds as per the following details. First, the amount of investment, mutual funds A, B and C. NAV at the time of purchase is given to you. Dividend yield up to 31st March 22, and then NAV, and then annualized yield is given. Okay, so there is a dividend yield given, closing NAV is given, and then there is an annualized yield. Remember, annualized yield is, let's say, P1 minus P0 plus D upon P0 into 100, but into, let's say, 365 divided by days or 12 divided by months, as the case may be. Assume 1 year is equal to 365 days. Mr. D has misplaced the documents of his investment. You are required to help Mr. D to find the following: number of units allotted in each scheme. So over here, at the time of investment, NMB was 10, so this is 2 lakhs divided by 10, that is equal to 20,000 units allotted. In the second case, 5 lakhs divided by 25, NAV was there, so again this is, I think, 20,000. And last is 4 lakhs divided by 20 initially, and hence this also appears to be 20,000 to start with. Second, the value of his investment as on 31st March 2022. Now, unless given otherwise, the number of units remains the same, and hence it is not a dividend reinvestment plan. So if you look at the value of investment, 20,000 into 10.5, 20,000 into 22.8, and 20,000 into 20.8. So if you go to see over here, each of them is having 20, 20 and 20, multiplying the respective numbers, you will get around 10,82,000 of your total value. So this is the second part. The holding period of his investment in number of days as on 31st March 2022. Now this might become a little tricky. So when you want to find the holding period, you would say that, well, how do I calculate the holding period? Well, I need to find a return, for which I need the NAV, which I have. I also need the dividend. Now dividend is given in percentage form. Now this dividend will be a percentage usually of the face value. However, face value 1 is not given. Second, it is dividend yield. So probably dividend yield is going to be calculated as a percentage of your market price, because it is yield. General dividend is a percentage of face value. So if I want to find the total return, when you look at capital appreciation, let us say for each of the funds, for A, for B and for C, capital appreciation would be, it is going from 10 to 10.5, so that is 0.5 into 20,000 units. So this is around 10,000 rupees. For B, the capital appreciation is 25, say 22.8. So this is actually a reduction of 2.2 into 20,000, and hence this is a negative, I think, 44,000. And for the third fund, it is 20, say 20.8. So that's a 0.8 appreciation on 20,000. So this is probably 16,000. This is your capital appreciation. Then I look at the dividend. So the dividend over here would be a percentage of the initial investment. 3% of 2000 comes to probably 6. Then there is 5% of, so this is 25,000, 5% of 5,000, 4% of 4 lakhs, so this is 16,000, and hence the total return, if you go to see, is going to be 16,000, is going to be a negative, if I am not wrong, 19,000, and is going to be 26,000. This is basically on my total investment of, let us say, 2 lakhs, total investment of 5 lakhs, and total investment of 4 lakhs. So if I go to see, 16 minus 19 plus 26 comes to around 23,000 or something. Just a second, let me just verify this. 16 in the first case, yes. Negative 19 in the second case, yes. Last time it is coming as, okay, sorry, 16 and 16 comes to 32, my bad. So this is 32, and hence if I total, probably the total yield comes to 29,000. Okay, so this is 32,000. And if I want to find the holding period return directly, 16 divided by 2 lakhs comes to 8%, but 8% is the return for the holding period. It is not a per annum return. I don't know how long is the holding period, but whatever it is, on A it is 16 on 2 lakhs, on B it is 19 on 5 lakhs, comes to a negative, I think 3.8, and lastly this is 32 on 4 lakhs, comes to again 8% return. This is holding period return, whereas the return given at the end is the annualized return. The question is asking you to find the holding period of investment in the number of days. So if I look at it for each level, let us say if I'm able to do it for one, I should be able to do it for the others. So if I look at A, my total investment return is 16,000 in the numerator on a total investment of 2 lakhs in the denominator, into 100. If I want to find the annualized return, this is into 365 divided by D. If I do all of this, my answer should be the annualized return number, that is 9.733. One should be clear that we should not confuse this with 8% return, which is just for the holding period. We want to find the number of days in which this was held. So this is going to be 16,000 upon 2 lakhs into 100, that is 8, into 365, that is, let us say, 9.733 equals 2920 divided by D. Therefore, if I take D on the other side, divided by 9.733 comes to, let us say, approximately 300 days. So the holding period is going to be 300. If you want, you pause the video at this stage and try to do the holding period calculation for, let's say, fund C on your own. So if you look at fund C, for example, this is a 15% return annualized. So if I go to C, for fund C, this would be 15 equals, let's say, a return of 32,000 on a total investment of 4 lakhs into, let us say, 100 into 365 divided by D. Again, if you do the math, this will come to, let us say, 8 into 365, that is 2920 divided by 15, and this comes to approximately 195 days. So as you can see over here, this is 300 days, this is 195 days. In the second case, it comes to around 124 days. So this is the calculation for number of days. Then comes a slightly tricky point, which is dates of original investment. Now, a lot of times students do have a problem over here on how to calculate dates. Should I include the first date? Should I include the last date? Institute does the calculation on a very simplistic basis. They take a calculator and do the workings. Like if I look at 195 days, for example, from behind, I would say in March, I have 31 days on my calculator. If it's not a leap year, in February 28 days, in January 31 days, in December again 31 days. So I'm at 121 days. Again, November is 30 days, October is 31 days. So on my calculator, from October to, let us say, 31st March, I am at 182 days. Now this is 195 days. So I will say 182 minus 195, that is 30 days. 13 days. So these 13 days, if I go back, I will be able to get the answer. But these are 13 days in September. September has 30 days. So 30 minus 13, that comes to 17th. So your answer will be 17th of September 2018. 11 for example, 2021 for example. So if you go to see, this is 17th of September. In the other case, for example, if I look at 300 days, if I remember back, 182 days was till October starting, then plus 30 for September, plus 31 for August, plus 31 for July, I see 274. Now I'm very close to 300, so I do 300 minus 274, I come to 26. I see a 26 on my calculator. This is in the month of June. June has 30 days. 30 minus 26 will come to 4, which means my answer will be 4th of June. This is what the institute does. Don't go into that headache of should I include the first day, should I include the last day. Keep it simple, do it the way institute does it, and you will get your marks. So over here, this is the dates of original investments, then the total return on the investment. Now the total return is 29,000 on probably a total investment of around 11 lakhs. Now I will, if I look at just the total return, ignoring annualized, the question is not asking you annualized return. So it will be 29,000 divided by 11 lakhs, which comes to, let us say, around 2.636 or 2.64%. This is your total return. Now 0.6 says, assuming the past performance of all the three schemes will continue for the next 1 year, what action should the investor take? Okay, if the past performance continues over the next 1 year, that is 12 months, A will give me 9.7, B will lose 11.85, and C will give me 15. So given a choice, I will sell my investments of A and B and put all the money in C because that is giving me the highest return. What will be the expected return of the next 1 year after the above action? Well, all my money, if it is deployed in C, I will at least get an annualized return of 15%. So I will try to sell A and B and invest that money that I have, let us say, in C. Will your answer as above in 0.6 change if the mutual fund charges an exit load of 5% of the investment redeemed within 1 year? If so, advise the investor what and when the action should be taken to optimize the return. Now, your answer was that I will sell A, sell B and invest in C. Now, if I were to sell A, I have earned some return, probably around 8% or so holding period return for 300 days. However, if I exit today, I will have to pay a 5% exit load. Instead of doing that, I can save a 5% exit load, keep the money invested probably for another 65 days and then exit. So rather than paying 5% exit load, I will continue to hold this investment of A for another 65 days because I've already held for 300 days. Beyond that, exit load is not levied. And then sell A. For B, it is a loss-making investment. It is burning my money. So even if exit load is charged, I will pay that, exit B and put the money in C. In any case, for C, I don't have to do anything separately. I will continue to remain. So if the fund charges exit load of 5%, then investor should redeem units of B and units of A after 65 days. How did you get 65? 365 minus 300. So after that 65 days, 1 year is crossed and hence you will not pay the exit load for A. I'm sorry, I think my screen got stuck while discussing the last point, but what we were just trying to say is for mutual fund B I can exit now, but for mutual fund A 65 days. 65 is calculated as 365 minus 300. After that you can exit. And we will now go to question number 2. So question number 2 is a fairly popular question. Institute usually likes asking you this question. Let us review this. Mr. X on 1st July during the initial offer of some fund had invested 10,000 units having a face value of 10 per unit, which means the total investment must be 1 lakh. On 31st March 2001, that is probably 9 months later. You had invested on 1st July 2000, now 9 months later, the dividend offered by the mutual fund was 10%. 10% is a percentage of face value. So if your total face value was 10,000 into 10%, that is coming to 10,000 rupees. And Mr. X found that his annualized yield. Remember, this is an investment for only 9 months. If annualized yield is given, that means you have done an adjustment of return into, let us say, 12 by 9 at the end. Annualized yield was, let us say, 153.33%. Okay. On 31st March 2002, 20% dividend was given. Now dividend is again a percentage of face value. This dividend is given on 31st March 2002, that is at the end of the second year. This dividend was given at the end of the first year, remember that. On 31st March 2003, you are at the third year, Mr. X redeemed all his balance. Okay. 11,296.11 units when his annualized yield again was 73.52%. Annualized yield again, as we said, must be the yield from the period 1st of July 2000 all the way up to 31st March 2020, 2003, which means that is for a 33-month period approximately. But how did you land up with 11,296.11 units? At the beginning of the question, you were quite clearly given that you have only 10,000 units. Is there details of new units purchased given anywhere? Well, no. Is there any bonus given anywhere? No, but there is a dividend given. Now, usually we assume that dividend is received in cash. However, the dividend may also be reinvested, in which case additional units are obtained. So, in this case, possibly additional units are obtained. What are the NAVs on 31st March 2001, 2 and 3? So, let us say the NAVs at 31st March 2001 is X, on 2 is Y, and on 3 is Z. So if I were to do the workings, let us say for the first year, I would say that in 2001, if I want to find the total return, I will say 153.33 is the annualized return, which will equal to, because it is a dividend reinvestment plan, clearly because there are more units which are there at the end, then I will have to find the return on a totality basis. So this will be your total return for the first year. The total NAV for the first year minus the total investment. So over here, your units are going to be 10,000 plus. You have received rupees 10,000 of dividend, but you have reinvested it. But when was this dividend given? It was given probably on 31st March 2001, where the NAV we're assuming is X. Into, so this is going to give you old plus new units into X. This will give me my total investment. Okay, so if I solve this, 10,000 X, if I open the bracket and then plus, this X and X will get cancelled if I open the bracket. So this is plus 10,000. This will be my total value at the end of the first year, minus I initially invested 1 lakh, divided this entire thing by 1 lakh. Will I add the dividend separately? No, the additional units have been added, and hence you don't have to separately add the cash part of dividend. Into, let us say 100, into, let us say 12 by 9, because this is annualized return. Now what will we do? We will take 100 and 12 by 9 on the other side. So this is 153.33 into, let us say 9 by 12, and again divide by 100, equals 10,000 X minus, let us say 90,000, the entire term divided by 1 lakhs. If I were to solve this, this is probably 1.15 you will get. Multiply this by 1 lakh, so this is 1,15,000 equals 10,000 X minus 90,000. You take 90,000 on the other side, so this is 1,15,000 plus 90, probably 2,05,000. 2,05,000 divided by 10,000 will give you X, and hence this X is equal to 20.5. This will give you NAV at the end of the first year. Now if you go to the second year, that is 2002, you have just been given that there is a 20% dividend. Now this dividend will be based on the units that are there during the year. How many units are there? Well, 10,000 were there, plus probably rupees. So if I want to find the new units on 31st March 2001 would be rupees 10,000 divided by, let us say 20.5, and hence if I do this, 10,000 divided by 20.5 will come to around 487.8 units. So I will say that in 2002 I have 10,487.8 units whose face value is rupees 10, and they have given me a 20% dividend. So this is 10,487.8 into 10 into 20%, and you will probably get rupees 20,975.6 worth of dividend. But if I want to find the NAV for the second year, I don't have the annualized return for the second year. I don't have any other information except for that one line. So how will I solve? Well, over here we can say that the units are going up to 11,296. There is dividend in year 1 which we have considered gives you 487 units. There is dividend in year 2 which I don't know gives me how many units, and there is no dividend in year 3, which means we can clearly say that the new units that I expect to get in year 2 would be 11,296.11 minus 10,487.8, that is approximately 808 point something, right? So this is 11,296.11 minus 10,487.8, approximately 808.31 additional units. However, new units are nothing but the dividend amount, that is 20,975.6, which is declared on 31st March 2002, end of the second year, upon the NAV on that date, which is Y, which will equal 808.31. And therefore, if I were to solve Y equals nothing but 20,975.6 divided by 808.31, Y equals around 25.95. You are done with the second year, and then you are in the third year, 2003. This is the simplest. Remember, 73.52 is given to you as the annualized return. That is a per annum return over the entire period. Now, I know there is 11,296.11 units when the NAV was Z at the end of the third year on a total investment of 1 lakh divided by 1 lakh again into 100, but for annualization this will be 12 by 33. One needs to be very careful. There is a similar sum in your study material which we have also included in the homework section, where institute has given you same question, same data, but instead of writing annualized return, they have written holding period return. So in the first year, instead of 153.33 which is annualized, they have written 115% holding period. In the last year, instead of 73.52 annualized, they have written I think around 202 or something holding period. If it's a holding period return, you don't have to do a 12 by 33 or 12 by 9 adjustment. Because it is an annualized return, we are doing that. So be very careful. A lot of students have a doubt in that why are we getting a different answer? Because this is an annualized return question. Another question can be a holding period return question. So this will be, if I take 73.52 upon 100 into 33 upon 12, let us say into 1 lakh. I will take 1 lakh now only, equals 11,296.11 Z minus 1 lakh. So if I do all the math on the left hand side, this is what I'll get, around 2,02,000 and something, 7.7352 into 33 divided by 12 into 1 lakh, 2,02,180 plus 1 lakh equals 11,296.11 Z, and hence your Z will equal, let us say your Z over here will equal plus, let's say 1 lakh upon 11,296.11, which will be 26.75. So these are the three NAVs. If you verify, you will get for the first around 20.5, second you will get around 25.95, and the end you will get 26.75. You can even do another alternative method as long as you are getting the same answer. So that is question number 2. Next you go to question number 3. In this case, you have a classic case of a dividend reinvestment plan and a bonus plan. So a mutual fund company introduces two schemes, dividend plan D, bonus plan B. The face value is rupees 10, and on 1st April 2005, K invested 2 lakhs in each, that is in both of them, D and B. But the NAV was 38.2 and 35.6 respectively. Both the plans matured on 31st March 2010, which is after 5 years, that is around 60 months. So if I want to find how much was the number of units allotted, I will say 2 lakhs divided by 38.2, let us say for the first plan, and hence 2 lakhs by 38.2 comes to around 5235.6. So in the dividend reinvestment plan, this is 5235.6. Obviously in bonus plan, it will be something else. Particulars of dividend and bonus are given. So you have been given data. Dividend is given on which dates? 1. So this is 10%. NAV on this date is 39.1. Second, 15%, 13%, 16%. Other dates there are bonus. You are required to find the effective yield on a per annum basis in respect of the above two plans. So first we look at the dividend reinvestment plan, which is a slightly complex working, where you will first try to find the return. But for return, you need the total number of units at the end into the NAV at the end. I have the NAV at the end, it is given in the table, but I don't have the total units at the end. So how will I calculate? Well, I will start with the units that I have at the beginning, then keep on adding the units at each date. So I think there are 4 dividend payment dates. So if we take those 4 dates, I mean, rather than writing down the exact date, if you take the 4 dates, the dividend percentage and the NAV on each dates. So this is, let us say, dates 1, 2, 3, 4. Your opening units, let's say to start with, it is 5235.6, I think. Dividend percentage, if you see, this is 10, then it is, I think, 13, then it is, I think, 15 and 16, something like this. Yes, no, 15 and 13. So this is 15 and this is 13. And the NAVs on these respective dates, 44.2 for the second date, 45.05, 44.8 for the last date, and maybe 39.1. Okay, so what are we going to do? We are going to find first the dividend in rupees and then divided by the NAV to find the new unit. So if I find the dividend, let us say in rupees, it is quite easy. 5235.6 into rupees 10, because that is the face value, into 10%. That is, I think, 5235.6 divided by 39.1, and hence your closing NAV will be used as a base. So this will be 133.9. If I add 5235.6 plus 133.9, I will probably get 5369.5 into 10, that is the face value, into, I think, 15%, that is 8054 approximately 0.25, divided by 44.2 comes to around 182.22 if I am not wrong units, and so on. So if you go to see over here, you have 133, 182.22, similarly you will have 106 and 160 and 204 units. Ultimately, all said and done, you will reach 5915.93 units. So we will say that at the end of the day, you know what, all said and done, I will have the closing units. So this was, let's say, the new units, and then you find the closing was 5369.5, and so on and so forth. If you keep on doing this working, if you want, pause and practice this. 5915.93, it is a pure mathematical process. 5915.93, this is my closing units. Now at this point, my closing NAV is 40.4 when the fund is going to be maturing. So my total return, if I want to calculate, would be 5915.3 into rupees 40.4. That is the total value that has become on my 2 lakh investment, divided by my 2 lakh investment into 100. Now this will give me the holding period return, but the question is asking me to find the effective return per annum. And hence I will have to do, let us say, into 12 by 60 or into 1 by 5 as the case may be, to find the annualized return. So this is 5915.3 into, was this the right number? 5915.93. 5915.93. 5915.93 into 40.4 comes to around 2,39,000. 003.57 minus 2 lakhs, and then all else remaining constant. So this is minus 2 lakhs upon 2 lakhs. So that is around 39,000 worth of return. That comes to 0.195 approximately into 100 into, let us say, 12 by 60. Simplicity. And this is around 3.9%. So all of this said and done, it will be 3.9% per annum, and this is how the institute has solved most of the problems. In certain cases, there may be complexities which may arise due to capital gains. Short-term capital gains tax may be levied, STT may be levied. If there is STT, then on securities transaction tax, if I am going to sell this at 2,39,000, I will subtract the STT and get the net sale proceeds. If there's a capital gains and there's a short-term capital gains, I will say that the last unit was allotted on 27th March 2009. I'm redeeming on 31st March, and hence there is no short-term capital asset. there will be no tax. If there was less than 12 months, there could have been tax. Now another challenge that can happen is compound interest. So we can say that 2,39,003.57 equals 2 lakhs into 1 plus r raised to 5, and from that you can find r using either logarithms, etc., using calculator approach. But from an exam perspective, I can easily say they can use this simple method, unless a question specifically asks you, where we have given an extra method if you want to do using compound interest. Now this is, let us say, for dividend reinvestment plan, which is a little more complicated. When it comes to bonus plan, initially 2 lakhs divided by 35.6. 2 lakhs divided by 35.6 comes to around 5617.98. These are the number of units. The first time you are getting a bonus is 1:5 bonus, which means divided by 5, there will be another 1123.60 units. Originally there were, let us say, 5617.98 units, and hence your closing units approximately 6741.5. If I go to see 6741.5, as you can see over here, on the next bonus date it is 1:8. So on this value divided by 8 comes to 842.69. So this is 842.70 approximately, and hence your total is 6741 plus 842, and this is 7584. If I total both of this is 7584. On the last date your bonus is divided by 10, and then 758. So if I add 758, closing comes to 8342. This is relatively easier as compared to dividend reinvestment in my understanding. So over here, if I want to find a total return, I will say 8342 into the NAV at the end for this plan, which is 39.7. So into 39.7, 8342.71 into 39.7 comes to around 3,31,205.59 minus 2 lakh rupees that you had invested upon 2 lakhs into 100 into again 12 by 60 or 1 by 5. So it will come to around 13.12% using simple interest. You don't separately need to do any compound interest workings over here. So this is one of the sums an institute can keep some of the information here or there missing, maybe give information like tax, STT, and require you to do the calculations. So this was one of institute's favorite type of questions. Next you have question number 4, where you are asked to calculate something like NAV. So from the following particulars relating to a fund scheme, you have investment in shares, let us say at cost of pharmaceutical, construction, so various 5 sectors. Investment in bonds, these are fixed income items. Listed bonds, unlisted bonds, number of units, expense payable, cash and cash equivalent, market expectation on listed bonds, various data is given. Fund has incurred the following expenses, you have been given, and particulars of each sector are given below. So you have been given the index on the purchase date and valuation date. So basically for pharma companies, when I purchased at cost, my purchase cost was 158, but then the index of that pharma companies was 300, which is now becoming 500. So basically if I want to find the market value today, it will be into 500 divided by 300. So basically this is 158 into 500 divided by 300 comes to probably 263. Today it must be worth 263. Second, for construction companies in a similar way, when I purchased it was 275, now it is 490. So into 275 by 4, into 490 by 275. It is like indexation. 490 by 275. This is 62 into 490 by 275. And hence this is what? 110.47 and so on. We will do this for each of the 5 sectors. Okay, and hence you will find the fair value. So if you go to see 263, 110, similar workings for other sectors as well. You are required to calculate the NAV of the fund, then NAV per unit. Now that is easy. NAV per unit is nothing but the total net assets of the fund divided by the number of units. So over here in the net assets, you will have construction companies and service sector companies. This is around 196 point something. Then 129. 33 total, this comes to 733. So your equity portfolio is worth 733 as of today. But do I have only equity portfolio? No sir, I also have bonds. Now bonds over here, first I have listed bonds, that is 8,000, 14% bonds of rupees 30,000 each. In the old study material there was a printing mistake. They have taken the face value at 15,000 and hence things are not very logical. But if you take 30,000 it does make sense, which means 8,000 into 30,000, the face value is around 24 crores. As you can see over here, this is 24 crores. Now these bonds have a coupon of 14% and the market expectation on these bonds is 8.842%. Now this is like the required rate of return. Now we have not been given the tenure of the bond. So if you were to value a bond which is there up to perpetuity, that is nothing but interest, that is 24 crores into 14%, that is interest upon KD, which is 0.08842. That is 24 crores into 14% comes to 3.36 divided by 0.08842. 0.08842, which comes to what? Approximately 38 crores. So this comes to, let us say, approximately 38 crores. This is a market value of this bond portfolio. Unlisted bonds, well, if nothing is given, then we will assume that the unlisted bonds have the same value, that is 14. So over here, you will have your equity portfolio, which is worth 733.209. plus bond portfolio, which is made up of 38 plus 14. So this is 38 plus 14. Number of units are there. Expenses payable is a liability, which is 7 crore. Cash and cash equivalent, that is an asset you will add. And then there is expenses payable, which is a liability at 7. Now a student says that, well, what about these charges? Well, these are incurred by the company, of which some of them may be paid, and if they're paid, cash is already reduced. You don't have to give effect to that again, because cash balance is already after paying expenses, and whichever expenses are unpaid, you are already showing it as expense payable, and hence no separate adjustment is to be done, at least in this case. If you are given opening cash balance, yes, then you will subtract these expenses to find the closing cash balance. So over here, probably 733.209 plus, let's say, 38 plus, so this comes to 781.209 divided by the number of units, which is 8.4 crores, and hence this is around 93. Your NAV will probably be 93. 781 net assets, 93 is your NAV. This is your answer of part 1 and 2. Next you go to part 3. Part 3 says, determine the NAV, the net return annualized, if the period of consideration is 4 years and the fund has distributed ₹2 per year as cash during the same period. Now for this, I have all the data points. The problem is I don't have the, you want to find the net return. Well, I don't know what the NAV would be at the beginning. So let us assume this is not a dividend reinvestment, bonus or other plan, and hence the number of units continue to remain the same, that is 8.4 crores. But what will be the net assets? Well, net assets would be at cost. All of these items would be shown at cost, 158. So this is what? 158 plus 62 plus 112 plus 68 plus 20 plus 24 plus 14. 458. We don't have any expense payable, we don't have any cash unless otherwise given 4 years back. So this is 458 worth of net assets unless otherwise given, divided by 8.4 crore units, and you are at 54.52. Now if I look at finding the annualized return, I will say that today something is worth 93, which was earlier 54.52. This has happened over a 4-year period, but over and above that, I have also received 2 rupees per unit for 4 years. So 2 into 4 is equal to 8 rupees. So on a total investment of 54.52, I got 93 of NAV today and 8 rupees worth of dividend. So in percentage and into 1 by 4, if I want to find the annualized return. So this is 93 minus 54.52 plus 8 upon 54.52 into 100 divided by 4. So this is approximately 21.31%. So this will come to, let us say, 21.31 percentage per annum. Okay, and then you have question 5. Now, to be honest, question 5 is more of a portfolio type of a question rather than a mutual fund type of a question. But nevertheless, this is a master question which will revise everything or most of the things of portfolio, of mutual funds. So we will kind of review this. Mr. Abhishek is interested in investing 2 lakhs, for which he is considering the following 3 alternatives. You either invest fully 2 lakhs in X, either invest fully 2 lakhs in Y, or invest 1,20,000 in X and 80,000 in Y. So that's a 60-40 weight, 3 positions. Average annual return earned by X and Y is 15 and 14 respectively. Risk-free rate of return is 10. Market return, that is RM, is 12. You have been given a table which is a little difficult to comprehend. So covariance of returns of mutual fund X, Y and market portfolio, that is mix, are given as follows. So this is as above rather. These are given. Now, how do you interpret it? This is covariance. But MFX with MFX, this will be like the variance of X. But MFX with MFY, this will be covariance XY. This will be covariance X and market. Similarly, next you see this is Y and X. Well, this will be the same number, 4.3, 4.3. This is nothing but the covariance of Y and X. But the second one is the variance of Y. Third one is covariance of Y with the market. Similarly, for mix, you have been given this same 3.37. You can see the same 3.37. 2.8, the same 2.8. So the last one is variance of the market. So you will have to interpret this table fairly well. And if you have done that, half the job is done. You are required to calculate the variance of return from MFX, MFY. Well, MFX is given, variance is 4.8. MFY is given, the variance is 4.25. And market, well, this is 3.1. This is based on the data which is given. 4.3, 4.8, 4.25, 3.1. This is based on these 3 data points, 1, 2 and 3, directly given. Second, the portfolio return, beta, portfolio variance and portfolio standard deviation. Now, when I look at the portfolio, the first position is 100% X, second position is 100% Y. So over here for portfolio return is nothing but the return of X. So if I look at the second sub point, I will say that for the first, second and third portfolio, your return, your beta, your variance and your standard deviation. So when I look at the return, 15%, which is a return. Beta, now how do I calculate? Well, beta is calculated as covariance of the security with the market. So that is 3.37. So if I look at this, covariance of X with the market upon variance of market. So if I pick up the right numbers, I am sorted. Covariance of X with the market is 3.37. 3.37 upon the variance of the market is 3.1. If I do it properly for one, I will be able to do it for the others as well. So this is approximately 1.09. So if I go to see the beta is 1.087 or 1.09. Perfect. So this is 1.09. Variance of X is given to you as 4.8, and if you want to find the standard deviation, square root of that is 2.19. So over here, as you can see, if I can do it properly for one, the other should also follow. That is, in the first case, I will say that my return is 15%, my beta is 1.08, variance is 4.8, standard deviation is 2.19. Are we clear with this? Okay, the similar working also happens for Y, and then you do it for portfolio. Now portfolio, probably 3 3, you'll have to do 60-40 weight where you take the portfolio return, 60% of X, that is 15% return, plus 40% of Y, that is 14% return. Find the weighted average. Again, portfolio beta. So if you go to see, the only challenge over here is in the third case. So if I look at the third case, in the third case, you have alternative 3, 60% and 40%. So portfolio return is going to be the weighted average return. Portfolio beta is going to be the weighted average beta. When I look at the portfolio variance, I will have to take weight squared X into variance of X, weight squared Y, variance of Y plus 2 into standard deviation X, standard deviation Y into correlation. I don't have the correlation, so instead of that I'll take the covariance. So into 0.6 into 0.4 into covariance between X and Y, that is 4.3, and I get 4.472. You can practice this. Okay, and then you look at, let us say, the expected return, systematic risk and unsystematic risk. The expected return is like CAPM return. RF, which you have as 10% plus RM 12 minus 10 into beta. The beta is already calculated, let us say 1.09. So if I were to find the expected return, that is 10 plus 12 minus 10 into 1.09. So approximately 2 into 1.09 plus 10, that is around 12.18 for the first case. So if you go to see 12.17 or 18. Next you want to find the systematic risk, which is a beta squared, that is 1.9 squared into variance of the market. Now variance of the market is 3.1. This is already variance and hence I don't need to square it again. 1.09 into equal to into 3.1, which is approximately 3.68. Now if I want to find 3.6 something, if I want to find the unsystematic risk, that is calculated as the total variance, that is 4.8 minus the systematic one, that is 3.6, and hence you will land up with around 1.13. So this will be, let us say, 1.13. Similar working you can pause and try for Y, and then you can pause and try even for the other third portfolio. Last is Sharpe ratio, Trenner ratio and alpha. Alpha can be alpha under characteristic line or Jensen's alpha. If I look at the Sharpe ratio will look at my actual return. Actual return, let us say for X, will be 15% minus the required return, which I calculated probably at, I think it was calculated at 12.18. Yes, 12.18 upon standard deviation, which was 2.19. So this is 15 minus 12.18 upon 2.19, and it comes to 1.28. This is Sharpe ratio. If you look at the Trenner ratio, again this is 15 minus 12.18, but this time divided by beta of 1.09. So over here, this was, let us say, 1.29 Sharpe ratio, 15 minus 12.18 upon 1.09 comes to, I think, 2.58, which is the Trenner ratio, and Jensen's alpha is nothing but actual minus required. So sorry, this is wrong calculation. 12.18 is the required, so 15 minus 10, 15 minus 10, so this is 5 divided by 2.19, this is 2.28, 5 divided by 1.09, 4.58, and Jensen's alpha will be 15 minus 12.18, actual minus required, which will be around 2.82. Alpha as per characteristic line is X bar, that is 15, minus beta 1.09 M bar. M bar over here is 12%, that is the return of the market. So if I look at this, for the first instant, Sharpe ratio is 2.28. I think I have gone on the other side of the margin. So let's say this is 2.28. Then you have for the second one, this is 1.9 approximately, Trenner ratio. This is for mutual fund X, 4.6 or something. So that is 4 point something. And Jensen's alpha is 2.28 or something. So over here, this is briefly the discussion regarding question number 5, and this is a question which I would recommend that if you want to practice your systematic, unsystematic risk, portfolio standard deviation, interpreting the covariance table, Sharpe Trenner ratio, it's a good question to practice. Apart from that, if you want to practice for that dividend equalization concept, there's a separate video for dividend equalization. You can do the same. So that should be it for today for mutual funds. I hope this video was helpful. If yes, please press the like button, share and subscribe, and do let me know in comments if you need any other specific help. Till next time, goodbye, good luck and take care. See you soon.